Welcome. Today we're diving into the world of Treasury bills, often called T-bills. These are short-term government securities that play a crucial role in the financial system. But what exactly are they and why should you care? Whether you're an investor, a saver, or simply curious about how the government manages its money, understanding T-bills can give you valuable insights. Let's start by exploring what Treasury bills are and how they fit into the broader economy. Treasury bills are debt securities issued by the U.S. Department of the Treasury. Unlike regular bonds, T-bills have short maturities, usually ranging from a few days up to 1 year. When you buy a T-bill, you're essentially lending money to the government for a short period. In return, the government promises to pay you back the full face value at maturity. The difference between what you pay and what you receive is your interest, making T-bills a simple and straightforward investment. T-bills are sold at a discount to their face value. For example, you might buy a $1,000 T-bill for $980. When the bill matures, you receive the full $1,000. The $20 difference is your earnings. This method of earning interest is called a discount method. There are no periodic interest payments, just the difference between purchase price and maturity value. This makes T-bills easy to understand and manage, especially for those new to investing. Treasury bills come in several standard maturities: 4 weeks, 13 weeks, 26 weeks, and 52 weeks. This flexibility allows investors to choose a time frame that suits their needs. Shorter maturities mean you get your money back quickly, while slightly longer ones might offer a bit more return. The variety of options makes T-bills attractive for both individuals and institutions looking to park their money safely for a short period. T-bills are issued by the U.S. Department of the Treasury, which is responsible for managing the federal government's finances. The Treasury uses the funds raised from T-bills to help pay for government operations and manage cash flow. Because they are backed by the full faith and credit of the U.S. government, T-bills are considered one of the safest investments available. Safety is a major reason people care about T-bills. Since they are backed by the U.S. government, the risk of default is extremely low. Investors trust that the government will repay its debts, making T-bills a go-to choice for those seeking security. This safety net is especially appealing during times of economic uncertainty, when other investments might seem too risky. Buying T-bills is straightforward. You can purchase them directly from the U.S. Treasury through the TreasuryDirect website or through banks and brokers. The process is designed to be accessible to both individual and institutional investors. You simply choose the amount and maturity you want, place your order, and wait for the auction results. Once you own a T-bill, you can hold it until maturity or sell it in the secondary market if you need cash sooner. T-bills are sold through public auctions, which are held regularly by the Treasury. At these auctions, investors submit bids indicating how much they're willing to pay. There are two types of bids: competitive and non-competitive. Most individual investors use non-competitive bids, which guarantee they'll receive the bill at the average auction price. This system ensures fairness and transparency in the process. A competitive bid, you specify the discount rate you're willing to accept. If your rate is too high, you might not get any T-bills. In a non-competitive bid, you agree to accept whatever rate is set at the auction, ensuring you get the amount you want. Most individual investors choose non-competitive bids for simplicity and certainty. This approach makes T-bills accessible even if you're new to investing. Interest you earn on T-bills is determined by the auction process. When demand is high, the discount rate is lower, meaning you earn less interest. When demand is lower, the rate is higher and you earn more. T-bill rates are often used as a benchmark for other interest rates in the economy, reflecting the overall demand for safe, short-term investments. Compared to stocks, corporate bonds, or savings accounts, T-bills offer a unique combination of safety and liquidity. While the returns are typically lower than riskier investments, the peace of mind and quick access to cash make T-bills a popular choice for conservative investors. They're often used as a place to park money temporarily while waiting for other opportunities. Liquidity refers to how quickly you can turn an asset into cash. T-bills are highly liquid because they mature in a year or less and can be sold easily in the secondary market. This makes them an excellent choice for investors who might need their money on short notice. The ability to access your funds quickly is a key advantage of T-bills over longer-term investments. T-bills are purchased by a wide range of investors, including individuals, banks, corporations, and even foreign governments. Their safety and liquidity make them attractive to anyone looking to preserve capital or manage short-term cash needs. For large institutions, T-bills are a key tool for managing cash reserves and meeting regulatory requirements. For individuals, T-bills can be a smart addition to a diversified portfolio. They offer a safe place to store cash, especially during uncertain times. Many people use T-bills to save for short-term goals like a vacation or a big purchase, knowing their money is secure and accessible when needed. Institutions like banks and mutual funds often hold large amounts of T-bills. These securities help them manage liquidity and meet regulatory requirements. Because T-bills are so safe, they're often used as collateral in financial transactions, adding another layer of stability to the financial system. T-bills play a vital role in the broader economy. They help the government manage its cash flow and provide a benchmark for other interest rates. When the government needs to raise money quickly, it can issue T-bills, ensuring it has the funds needed to operate smoothly. This stability benefits everyone, from individuals to large corporations. Rates set at T-bill auctions influence other interest rates throughout the economy. For example, banks often use T-bill rates as a reference when setting rates for loans and savings accounts. When T-bill rates rise, borrowing costs across the economy tend to increase and vice versa. This connection makes T-bills a key indicator for financial markets. Inflation can impact the real return you earn on T-bills. Since T-bills are short-term, they're less affected by inflation than longer-term bonds. However, if inflation rises rapidly, the purchasing power of your returns may decrease. Investors often watch inflation trends closely when deciding whether to buy T-bills. Interest earned on T-bills is subject to federal income tax, but it's exempt from state and local taxes. This tax advantage can make T-bills more attractive compared to other investments, especially for investors in high-tax states. Always consider the tax implications when adding T-bills to your portfolio. During times of market volatility, investors often flock to T-bills for safety. When stock markets are unpredictable, the stability of T-bills provides a safe haven. This demand can drive T-bill prices up and yields down, reflecting their role as a refuge in turbulent times. Central banks, including the Federal Reserve, use T-bills in their monetary policy operations. By buying or selling T-bills, they can influence the amount of money in the economy and help control interest rates. This makes T-bills a powerful tool for managing economic stability. T-bills aren't just popular in the U.S., they're also held by foreign governments and investors. Because of their safety and liquidity, T-bills are a key component of global financial markets. They help facilitate international trade and serve as a reserve asset for central banks around the world. While T-bills are considered very safe, they're not entirely risk-free. The main risk is inflation, which can erode the value of your returns. There's also opportunity cost. By investing in T-bills, you might miss out on higher returns from other investments. Still, for many, the safety and simplicity of T-bills outweigh these risks. Some people use T-bills as part of their emergency fund strategy. Because they're safe and liquid, T-bills can provide quick access to cash in case of unexpected expenses. This makes them a practical option for those who want their emergency savings to work a little harder than a regular savings account. T-bills are different from Treasury bonds and notes mainly in their maturity and interest structure. While T-bills mature in a year or less and pay interest at maturity, bonds and notes have longer terms and pay periodic interest. Understanding these differences helps investors choose the right product for their needs. Many investors use a laddering strategy with T-bills. This means buying T-bills with different maturities so that some mature every few months. Laddering helps manage cash flow and reduces the risk of having to reinvest all your money at once, especially if interest rates change. If you need to access your money before a T-bill matures, you can sell it in the secondary market. This market allows investors to buy and sell T-bills before maturity, providing flexibility and liquidity. Prices in the secondary market may fluctuate based on interest rates and demand. Corporations often use T-bills to manage their short-term cash needs. By investing in T-bills, companies can earn a return on idle cash while keeping funds safe and accessible. This practice helps businesses optimize their cash flow and maintain financial stability. T-bills are a key tool for the government to raise funds quickly. When there's a short-term need for cash, the Treasury can issue T-bills to cover expenses. This flexibility helps the government manage its budget and respond to unexpected financial needs. Central banks use T-bills as part of their monetary policy toolkit. By buying or selling T-bills, they can influence the supply of money and help control inflation and interest rates. This makes T-bills an important lever for maintaining economic stability. Financial planners often recommend T-bills for clients who need a safe, short-term investment. Whether you're saving for a specific goal or just want to protect your cash, T-bills can be a valuable part of your financial plan. Their simplicity and reliability make them easy to incorporate into any strategy. Some retirement accounts, like IRAs, allow you to hold T-bills as part of your investment mix. This can provide stability and preserve capital, especially as you approach retirement. T-bills can help balance riskier assets and ensure you have funds available when you need them. Parents saving for college sometimes use T-bills to protect their savings from market swings. Because T-bills are safe and mature quickly, they're a good option for funds needed in the near future. This approach helps ensure that tuition money is available when it's time to pay. Nonprofit organizations often use T-bills to manage their cash reserves. The safety and liquidity of T-bills help nonprofits ensure they can meet their obligations and fund their missions, even during uncertain times. This conservative approach supports financial health and stability. Trust funds sometimes invest in T-bills to preserve capital and provide liquidity for beneficiaries. The predictable returns and low risk make T-bills a reliable choice for trusts that need to balance safety with accessibility. Insurance companies often hold T-bills as part of their investment portfolios. The safety and liquidity of T-bills help insurers meet policyholder claims and manage their financial obligations efficiently. This practice supports the stability of the insurance industry. Pension funds use T-bills to manage short-term cash needs and balance risk in their portfolios. The predictable returns and low risk of T-bills help pension funds meet their payment obligations to retirees, ensuring financial security for beneficiaries. Local governments and municipalities sometimes invest in T-bills to manage their cash reserves. The safety and liquidity of T-bills help ensure that public funds are protected and available for community needs, such as infrastructure projects or emergency expenses. Endowments, such as those held by universities or charities, often use T-bills to manage short-term cash and reduce risk. The stability of T-bills helps endowments meet spending needs while preserving the principal for future generations. Charitable foundations use T-bills to safeguard their assets and ensure funds are available for grants and programs. The low risk and high liquidity of T-bills make them a practical choice for organizations focused on long-term impact and financial stewardship. International investors often buy U.S. T-bills to diversify their portfolios and gain exposure to the U.S. dollar. The global reputation of T-bills for safety and liquidity makes them a preferred choice for investors around the world, supporting international financial stability. The demand for T-bills can influence exchange rates. When foreign investors buy T-bills, they need U.S. dollars, which can strengthen the dollar's value. This relationship highlights the interconnectedness of global markets and the importance of T-bills in international finance. During financial crises, demand for T-bills often surges as investors seek safety. This increased demand can drive yields lower, but it also underscores the role of T-bills as a safe haven asset. Their stability helps calm markets and restore confidence during turbulent times. As economies recover from downturns, T-bill yields may rise as investors move back into riskier assets. The changing demand for T-bills reflects broader economic trends and investor sentiment, making them a useful indicator for market watchers. Summary: Treasury bills are a cornerstone of the financial system, offering safety, liquidity, and flexibility for a wide range of investors. Whether you're managing personal savings, running a business, or overseeing an institution, T-bills provide a reliable way to preserve capital and manage cash. Their influence extends from individual portfolios to global markets, making them an essential tool for anyone interested in finance.